When government deficits, AI capital spending, and energy shocks all compete for capital at the same time, every major asset class has to reprice. Welcome to vTalkInsight, Allocator's Lens Daily for August 7th, 2026. Cross-asset correlations are shifting, and traditional diversification is under pressure. So let's start with how this backdrop is feeding through to equities. In equities, the dominant story is exceptional earnings and AI-driven growth running straight into the headwind of higher yields and rising leverage. Price action still looks calm on the surface, with the volatility index back in the mid-teens and major indices hovering near highs. Yet the fundamentals and positioning underneath are anything but quiet. Corporate results remain remarkably strong. S&P 500 earnings for the second quarter are up around 50% year-on-year, or a little over 30%, even if you strip out big investment gains from companies like Google and Amazon. Revenues are growing as well, with all 11 S&P sectors reporting sales gains and aggregate revenue up in the mid-teens, while 10 sectors are expanding margins. What is different this time is that earnings strength is broadening beyond megacap tech. Industrials are beating expectations by a wide margin, helped by onshoring and capital expenditure on infrastructure and data centers. Value and smaller cap stocks are outperforming growth this year. And in Europe, sectors like metals, mining, utilities, and financials are finally contributing, helped by large fiscal programs aimed at industrial and physical infrastructure. Against that strength, valuation assumptions have become demanding. Current S&P 500 levels effectively price in more than 20% annual earnings growth for 5 straight years, a pace usually seen only just after deep recessions. That is hard to reconcile with a nominal growth environment closer to 6 or 7% and with margins that are already elevated, which is why some observers describe classic bubble dynamics, especially around AI and semiconductor names. Leverage is a key part of that concern. Borrowing spans wealth management accounts, margin loans, levered ETFs, and options, with hedge fund leverage relative to GDP now described as unprecedented. Leveraged ETFs may be a small share of assets, but can account for a large share of daily trading, helping to fuel late-day momentum and occasional flash crashes, like the sharp deleveraging seen recently in Korean equities. The AI complex shows how capital-intensive this cycle has become. Alphabet has raised roughly $80 billion of new debt and a similar amount of equity since October to fund gigawatt-scale cloud infrastructure, pushing free cash flow negative and halting buybacks. Other companies are lifting capital, spending by billions for AI segments, even as investors question payback periods and whether pricing power can hold against rising competition from Chinese chipmakers. That surge in long-lived investment effectively lengthens equity duration, making tech and growth stocks more sensitive than before to moves in the 10-year Treasury yield. At the same time, leadership remains narrow. A small group of hyperscalers recently accounted for more than 80% of S&P gains in a single week, and hedge funds with concentrated AI bets suffered double-digit losses during the last drawdown, while more diversified strategies were far more resilient. We are also seeing micro cracks where expectations were highest. Memory and storage names like Western Digital and SanDisk sold off hard after weak revenue guidance, dragging down Asian peers and reminding allocators how quickly sentiment can turn in crowded trades. Even in private markets, a $100 billion-plus block of SpaceX shares coming out of lockup has been testing appetite, with the float more than doubling overnight and price action swinging sharply as legacy investors decide how much to sell. For equity allocators, the key tension is that earnings and AI demand remain powerful, but growth assumptions, leverage, and sensitivity to long-term yields are all elevated. The upcoming jobs report, the next inflation prints, and any shift in the 10-year yield toward higher ranges could quickly change how sustainable today's equity narrative looks, especially for the most capital-intensive and crowded parts of the market. Turning to rates, the backdrop is one of persistent higher for longer risk as inflation, fiscal deficits, and policy uncertainty all feed into the long end of the curve. Even without fresh action from the Federal Reserve, financial conditions are tightening as yields grind higher and volatility around data releases stays elevated. Inflation remains the central driver. Recent energy moves and sticky price pressures are raising the perceived odds of at least 2 additional rate hikes sometime this year or early next. At the same time, markets are skeptical that inflation will fall back to the Fed's 2% target in the next several quarters, which keeps policy uncertainty and debate about the terminal rate alive. Fed officials continue to stress a data-dependent approach, with upcoming consumer price and personal consumption expenditures reports seen as more important than market pricing or even some labor indicators. There is growing skepticism about the value of forward guidance, with investors now asking for clearer explanations of each decision rather than detailed roadmaps that can quickly become obsolete. The 10-year Treasury yield, recently quoted around 4.6%, is seen by some as increasingly attractive compensation for duration risk. However, much of the recent move is attributed to rising term premium driven by concerns over large fiscal deficits, heavy issuance including very long-dated bonds, and uncertainty about how determined the Fed really is to contain inflation. Large multi-tranche issuance out to 40 years highlights how aggressively governments are raising capital, with the risk of crowding out private borrowers and keeping yields elevated. There is also discussion that Treasury might tilt issuance towards shorter maturities, which could put more pressure on the front end, even as long-end yields remain influenced by term premium and growth expectations. The labor picture sends mixed signals. On one hand, wage growth has cooled toward 3.5%, with stable hiring and low layoffs, supporting the case for a pause. On the other, pay for job switchers is running much hotter and quits remain elevated, so a combination of re-accelerating inflation and a still tight labor market could be toxic for bonds and trigger further sell-offs. Interestingly, market-based inflation expectations, such as longer-dated inflation swaps, are sitting near 2-year lows, suggesting investors still grant the Fed a degree of credibility on long-term inflation. Yet the traditional 60-40 portfolio is under strain as the historical negative correlation between stocks and bonds has turned positive, reducing diversification benefits and pushing allocators to think harder about term exposure. From an allocator standpoint, the key watch points are whether the 10-year yield drifts toward the psychologically important 5% area, how the upcoming jobs report lands, and what signals the Fed chair gives on balancing inflation risk against fiscal and growth concerns. Those signals will help determine whether today's higher income from bonds compensates adequately for the volatility and policy risk embedded in the curve. Credit markets are sitting between robust corporate earnings on one side and higher rate and liquidity risks on the other, creating a split between shorter-dated quality paper and more leveraged or illiquid exposures. Many allocators favor the front end of the curve, where yields are attractive and duration risk is limited, especially as higher gasoline prices begin to squeeze consumers and threaten weaker balance sheets. In private credit, portfolios are generally described as healthy. Foreclosures are rising but remain within modeled expectations, and institutional appetite for the asset class continues to grow. However, stress is building in deals struck at peak valuations during 2021 and 2022. 14 large transactions have already failed, and more are expected as investors choose to cut losses and recycle capital into higher return opportunities. There is still significant dry powder in both private equity and private debt, which is drawing more companies to market and spurring deal activity in areas like industrials that are seen as less exposed to direct AI disruption, but still benefit from data center and infrastructure demand. In software, investors are becoming more discriminating, separating businesses that can harness AI from those whose models are at risk of being displaced. On the banking side, consolidation in Europe, including developments around UniCredit and Commerzbank, and an expected merger in the Italian sector, points to efforts to strengthen balance sheets and simplify structures. In emerging markets, flows are rotating away from Asia and emerging Europe toward Latin American credits, such as Brazil, Mexico, and Colombia, while some investors are selectively adding exposure to higher risk names like Egypt and Turkey as risk appetite improves. Beyond traditional credit, alternative capital is flowing into areas such as wildfire catastrophe bonds, and family offices are increasingly looking at private infrastructure for its bond-like cash flows, lower volatility, and potential inflation linkage, even though many portfolios still have no allocation yet. Overall, credit markets remain open, but the price of capital and the terms on offer are shifting in favor of lenders, making careful selection and structure more important as the rate cycle matures. In foreign exchange, currencies are expressing the same tug of war between Fed policy expectations and geopolitical risk that we see elsewhere. Market views that the Fed will likely hold rates steady at the upcoming meeting point to a slightly weaker dollar, a steeper U.S. yield curve, and support for emerging market currencies and carry trades. Yet doubts about U.S. commitment to contain inflation are also resurfacing, fueling talk of a so-called sell America trade that tends to favor the euro and other alternatives. These narratives overlap with longer-term discussions about diversification away from the dollar, even though in practice global demand for dollar assets, especially from private buyers of treasuries, remains robust. The yen remains a focal point. Japanese authorities appear determined to defend around the 155 level, and coordination with the U.S. removes the hard constraint imposed by Japan's limited foreign exchange reserves. Recent intervention reportedly involved selling euros to buy yen, hinting at wider G7 involvement, while Japan's strong equity performance and large balance of payments surplus reduced domestic pressure for a rapid policy shift. For emerging markets, diplomatic progress in the Middle East, particularly around the Strait of Hormuz, could improve sentiment and investment flows, which would benefit more cyclical currencies if a durable deal emerges. Flows are already rotating into Latin American assets, and some investors are testing the waters in more fragile markets, although many emerging central banks remain cautious because of potential food price shocks linked to El Niño. Looking ahead, the key FX watch points are the Fed's communication at the next meeting, any renewed intervention around dollar-yen, and the trajectory of Middle East negotiations. Each of these will influence not just currency levels, but also cross-border capital flows and the relative attractiveness of dollar versus local currency exposures in global portfolios. Commodities, and energy in particular, sit at the center of the inflation and policy debate that feeds back into every other asset class. Oil prices have been pulled in opposite directions by shifting headlines around the Strait of Hormuz, changing flows from key producers, and varying degrees of demand weakness in China. Recently, crude slipped below $80 a barrel as hopes rose for a temporary deal to reopen Hormuz, but prices then firmed again as negotiations proved partial and regional tensions, including Houthi activity, kept a risk premium in place. Even if a 60-day agreement is finalized, it will be temporary, exclude the U.S., and leave broader nuclear and regional issues unresolved, so volatility is likely to persist. On the supply side, increased output for Venezuela and the United Arab Emirates and drawdowns from the U.S. Strategic Reserve have helped prevent a more dramatic price spike, alongside sharply lower Chinese imports. However, refined products remain tight, with diesel effectively priced at the equivalent of roughly $160 to $175 a barrel, creating exceptional profitability for refiners and adding to cost pressures across the economy. Precious metals tell a different but related story. Gold prices have been resilient despite macro headwinds and a seasonally weak period, suggesting much of the downside has already been absorbed and that structural demand remains intact. Silver has seen sharp moves as above-ground inventories have been drawn down after several years of undersupply, tightening conditions further. For multi-asset allocators, energy prices are a key input into the inflation outlook and Fed reaction function, while gold and silver provide potential ballast if geopolitical risks escalate or inflation surprises again to the upside. Developments around Hormuz, the coming winter in Europe and Ukraine, and the disconnect between benchmarks like Brent and the underlying physical market are all important to monitor as part of the broader risk management toolkit. Stepping back across assets, we have an equity market powered by extraordinary and increasingly broad earnings, but layered with ambitious growth assumptions, heavy leverage, and growing sensitivity to higher long-term yields. In rates, term premium, fiscal deficits, and questions over the Fed's reaction function are keeping yields elevated and challenging the traditional 60-40 portfolio, while credit still offers income, but is starting to expose the weak spots left by the last cycle's exuberance. FX and commodities round out the picture, with the dollar, yen, and emerging market currencies oscillating around policy and geopolitical shifts, and oil and precious metals transmitting those same forces into inflation expectations and hedging behavior. Allocators may want to focus on how incremental data on jobs and inflation, the Fed's next communication, and any breakthroughs or setbacks in Middle East negotiations ripple through this higher-for-longer, capital-intensive regime. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.